open your statement, and it's not even a number you recognize at first. $4,200. You didn't buy a car. You didn't have an emergency. It just happened. A dinner here, a flight there, a few months of I'll pay it off next month, and suddenly next month became 8 months ago.
And here's the part that actually messes with people psychologically. You feel like you understand money. You're not reckless. You're not maxed out on 5 cards. You have 1 card. You use it for everything because of the points, and you always pay something every month. So why does the balance never seem to move? Because here's an uncomfortable truth almost nobody explains clearly. Minimum payments aren't designed to pay off your debt. They're designed to keep you paying as long as possible.
Let's do the math, because the math is the part that actually changes how you think about this. Say you owe $5,000 on a card at 24% APR, which, by the way, is close to the national average right now. If you only pay the minimum, which is usually 2 to 3% of the balance, you're paying maybe $125 a month at first. At that rate, it takes you almost 19 years to pay it off.
Not 19 months,
19 years! And you have paid more than $7,000 in interest alone on a $5,000 purchase? That's not a math problem you're bad at. That's the system working exactly as designed. So in this video, I want to break down why credit card debt feels impossible to escape, what's actually happening behind the scenes, and the real step-by-step way out, without pretending you can just budget harder your way through it. My name is Mac, and if you've ever opened a statement and felt that specific kind of dread, hit subscribe, because this channel is about the stuff that actually works.
Let's start with why this trap is so easy to fall into in the first place. It's not because people are bad with money. It's because credit cards are engineered around a psychological blind spot, the gap between spending and feeling. When you swipe a card, your brain doesn't register it the same way it registers handing over cash. Researchers have shown people are willing to spend significantly more on a credit card than they would in cash for the exact same purchase, because the pain of paying is delayed. You feel the convenience now. You feel the cost later. And later always feels smaller than now.
Now, stack on top of that the APR itself. APR stands for annual percentage rate, basically the yearly cost of borrowing the money, expressed as a percentage. But here's what most people don't realize. That rate compounds. It's not just charged once a year. It's calculated daily on whatever you still owe, which means carrying a balance even for a few weeks adds up faster than people expect.
Let's compare 2 people. Person A has $3,000 in credit card debt at 22% APR and pays $150 a month. Person B has the same $3,000 balance, same interest rate, but pays $300 a month. Person A pays it off in about 24 months and pays roughly $700 in interest. Person B pays it off in about 11 months and pays around $300 in interest. Same debt, same rate, less than half the time, less than half the interest, just by paying more aggressively from the start.
That gap is the whole game. It's not about being smarter with money. It's about understanding that every extra dollar above the minimum is doing double duty. It's shrinking the balance and shrinking the time that balance has to generate more interest. But here's the second trap, and this one's sneakier. A lot of people think the solution is just pay more, full stop. And sure, that helps. But if you don't also stop the bleeding, you're bailing out a boat with a hole still in it. You pay down $400 this month, then a small $250 purchase goes right back on the card, and the balance barely moves. This is why so many people feel stuck for years. Not because they're not trying, but because they're trying to pay down debt and create new debt at the same time.
So let's get into the actual path out. 4 steps. Step 1, know your real number, not the balance, the APR, and the actual minimum payment math. Most people don't know their own interest rate. If you don't know yours, that's not a personal failing. It's just how these statements are designed, buried in fine print nobody reads. Pull it up right now if you can. That number is the thing you're fighting.
Step 2, stop using the card you're paying down. This sounds obvious, but it's the step people skip the most because it feels restrictive. Here's the reframe. You're not giving up the card forever. You're putting it on pause while it's actively working against you. If a card has a balance, treat it like a closed account until that balance is gone. Use a debit card or cash for spending in the meantime. You cannot outpay a balance that keeps getting new charges added to it.
Step 3. Attack the highest interest rate first, not the biggest balance. This is sometimes called the Avalanche Method, and the math behind it is simple. Interest is the thing draining your money every single day, so the debt charging you the most per day should get the extra dollars first, regardless of its size. If you have two cards, one with $1,000 at 26% and one with $4,000 at 14%, the $1,000 card is bleeding you faster relative to its size. Pay minimums on everything else and throw every extra dollar at that one until it's gone. Then roll that payment into the next highest rate. Now, here's a mistake that trips up a lot of people once they've absorbed step 3. They think the Avalanche Method means ignoring everything else completely. It doesn't. You're still paying minimums on every other card, you're just deciding where the extra money goes. Let's run one more comparison to make this concrete, because the gap here always surprises people more than they expect.
Imagine someone with 3 balances: $1,500 at 27% APR, $2,500 at 19% APR, and $6,000 at 12% APR. That's $10,000 total. A lot of people instinctively want to attack the $6,000 balance first because it looks like the real problem, but that 12% balance is actually the cheapest debt in the group.
The $1,500 balance at 27% is costing about $33 a month in interest on its own, even though it's the smallest number on the page. Put an extra $200 a month toward that one first, and it's gone in under 7 months. Roll that $200 plus its old minimum into the 19% balance next, and that one disappears far faster than it would have on its own. By the time you reach the 12% balance, the biggest one, you're throwing 3 payments worth of money at it at once. The total payoff timeline for all 3 balances combined ends up close to 2 years faster than if you just split payments evenly across all 3 from the start, or attack the biggest number first out of instinct. This is the part that's counterintuitive. Size feels urgent, but rate is what's actually expensive. Chasing the wrong number is one of the quietest ways people stay in debt longer than they need to. Step 4. Automate an amount above the minimum, even if it's small. This is the part people underestimate. You don't need an extra $500 a month to make real progress. Going from a $125 minimum payment to $200 a month on that $5,000 24% APR example doesn't just speed things up a little. It cuts the payoff time from nearly 19 years down to about 3 years and saves you well over $5,000 in interest. The amount matters less than the consistency. Automate it the same way you'd automate a savings transfer, so it doesn't depend on willpower every single month.
Let me tell you about someone I'll call Daniel. Daniel had about $6,000 spread across 2 cards, and for 2 years, his balance barely moved, even though he kept paying it. He wasn't reckless. He just didn't know his real APR, and he kept using the cards for groceries and gas because, in his words, it was already there. Every few months, he'd get a small windfall, a tax refund, a bonus, and throw a chunk at whichever balance looked biggest, which usually meant the $4,000 card instead of the smaller $2,000 one sitting at a much higher rate. It felt productive. It wasn't.
Once he actually pulled up the interest rate, 27% on one card, 15% on the other, something clicked. He stopped using the higher rate card completely, moved to cash for 2 months, and redirected an extra $120 a month toward it using the Avalanche Method, instead of splitting payments the way he used to. 14 months later, both cards were paid off, almost 5 months faster than his old approach was on pace for. He told me the hardest part wasn't the money, it was the moment he actually looked at the number instead of avoiding it.
That's usually the real barrier, not math ability, avoidance. Now, you might be thinking, okay, Mac, but what if I can't pay more than the minimum right now? Totally fair. And that's a real situation for a lot of people. In that case, step 1 still matters most. Call your card issuer and ask about hardship programs or a lower temporary rate. Issuers would often rather work with you than have you stop paying entirely. And a lot of people don't realize that's even an option because nobody tells them.
So let's recap the path out. Step 1, find your actual APR, not the balance, the rate. Step 2, stop adding new charges to a card you're paying down. Step 3, attack the highest interest rate first, regardless of balance size. Step 4, automate something above the minimum, even if it's small, because consistency beats intensity here.
Here's the truth most people don't want to hear. Credit card debt doesn't usually happen because of one bad decision. It happens slowly, through 100 small, I'll deal with it later moments. And getting out happens the same way, just in reverse. Small, consistent, boring decisions that compound in your favor instead of against you. If this helped you see your own credit card situation a little differently, hit subscribe. And I'm curious, do you actually know your current APR off the top of your head? Or is that a number you've been avoiding? Let me know in the comments, because that number is exactly where this starts. And if you want to know how this credit card trap affects your actual credit score next month, watch this next video right here.